Hi, I'm Jimmy. In this video, we're looking at MasterCard versus Visa. We're going to look quickly at their business, then we're going to look at some of their financials, and then we're going to try to come up with a fair value for both of their stock to see if we should buy them at the current price. Okay, now before we jump in, I just want to tell you real quick about a website that we're building. The website should be up and running by the end of the second quarter, and it might not look exactly like this. I built this in Excel to help show the developers where we're trying to go. But the idea here is that we can quickly punch in the ticker right up ahead. We punch in the ticker of the company we're interested in. It pulls down analyst estimates. That's the one in the green bar. The green letters are analyst estimates. We can have the computer do the rest of the calculations if we want them. We can go out up to 10 years, and in theory, what we're trying to do is identify a company that could be undervalued for us to do more research on. In this example, using AutoZone, well, it looks like using the company's own weighted average cost of capital as our required return, so in this case about 7.24%, well, the company could be undervalued. For me, I've been using 7.5%, so if that's the case, I want to ideally buy this stock below 21.30. So if you'd like to sign up for that website, I will leave a link in the description below. And if you sign up before the website goes live, we're locking in the price forever. So the price will never go up on you if you sign up before it. And again, it should be up and running by the end of the second quarter. So let's jump into the basics of how their business works. So in this simplest form, I took this diagram, a similar diagram was in, I believe, MasterCard's annual report. Great place. If you read the business section of an annual report, they usually do a very good job of describing the business. Both companies describe their business in the same way. I just sort of liked the way MasterCard laid it out. And basically, they called it a four-party system where you have the customer, the store that customer is shopping at, the bank that the store deals with, and then the bank that the customer deals with. So what happens is the customer buys something from the store, and in an instant, all the transactions are connected using either MasterCard or Visa. In return, MasterCard or Visa get a fee. This is one of the reasons that MasterCard and Visa should not be treated like a typical bank. They are a transaction-based business, so they get paid based on the fees that they collect, not like a bank where they'll get paid sort of interest on their services. That also makes discounted cash flow a good valuation method for both of these companies. Okay, now let's jump over to their revenue. So this is revenue for both Visa and MasterCard. And we can see that Visa has a little bit more revenue than MasterCard has, but not too much more. But what really makes this interesting in my eyes is that if we were to pull up a website like a Yahoo Finance and we were to look at, let's say, Visa's revenue, well, Visa on Yahoo Finance would show a revenue number of about $25.5 billion. But we're showing revenue of about $32 billion. And the reason for that is very important. And that's because when we click to these charts, well, these charts, we could see that the red amount is what both companies call incentives. So if you were to sign up for a Visa product or a MasterCard product, oftentimes you will get incentives for signing up. It could be points. It could be a lot of different things. There's all different types of incentives that they've set up with all of their partners across the globe. But MasterCard actually offers a bit more incentives on a percentage of total revenue basis than Visa does. But the way that they count it from an accounting standpoint, the way that those numbers appear, is they take those incentive discounts out of their revenue. So what would have been $32 billion ends up shaking out to be closer to $25 billion, which is why a lot of websites will show the $25 billion, even though in my eyes, the $32 billion is more accurate, because what's important here is that MasterCard has been doing more incentives. What does that mean? Well, when we click over to this chart, well, this is the two companies, Visa's in blue, MasterCard's in orange, and this is their revenue growth side by side. And we can see year after year, at least in recent years, MasterCard has had better growth, overall revenue growth, than Visa has, which implies that their incentive programs are working at least better than what Visa is doing. Now, one exception here, one big exception is if you look at 2017. In 2017, Visa had a big jump in revenue, and that was because of an acquisition that they made. And when a company makes an acquisition, well, they roll that revenue in. So, yes, there was a big jump in revenue, but it wasn't necessarily the same as organic growth. So I just want to bring that point out. Since then, well, MasterCard has outgrown Visa, but they also had a bigger negative number when 2020 came, when the coronavirus hit everything. And as we could guess, that is partially due to the fact that they're doing all these incentives, but people aren't. There's not quite as many fees being processed on their behalf. So overall, the revenue growth saw a decline for that year. But we can also see that analysts are expecting for the growth to continue going forward. Okay, now let's shift over to net income. Now, when we look at these net income charts, by the way, net income and profit are the same thing. This is the bottom line. How much profit does the company bring home? Well, when we look at the profit, we can see that Visa is doing much better than MasterCard is. But I would tie a lot of that back to the more aggressive incentive programs that MasterCard has. MasterCard has essentially been spending more money on incentives or applying more of their revenue to incentives, which would allow for them to make less profit in hopes of having greater growth. So if they were to tone back those incentives, well, in theory, they could really bump up their overall, call it, profit margins. And just to illustrate, these are the company's profit margins for each company as of their 2021 numbers. And we could see that Visa's profit margins were 53%, MasterCard came in at 44%. And that has been fairly consistent. MasterCard has been in the mid-40s, while Visa has been in the low 50s. So overall, it looks like Visa is a more profitable company. But I'm actually leaning towards favoring MasterCard from simply from the perspective, if they were to tone back some of their incentive programs, in my mind, that would slow their growth rate, sure, and they might end up with a growth rate in line with, let's say, what Visa is doing, but they would also likely see a bump up in revenue, a bump up in profit margins, and a bump up in profit, since lowering their incentives or lowering their rebates wouldn't lead to too many more expenses. So that would them toning that down at some point down the road would likely help their numbers all across the board. That being said, let's look quickly at their debt. So this is debt for both Visa and MasterCard. And again, we put them on the same scale so they could be easily compared to each other. And we could see, as of the most recent numbers, the 2021 numbers, well, Visa has more debt than MasterCard has. And that's going to be important because that will impact our fair value calculations. So using the discounted cash flow calculator that I mentioned before, well, using that, when we look at MasterCard first, using my personal required rate of return of 7.5%, well, looks like MasterCard stock is worth about $303 per share. When we look at the impact on debt, well, the net debt per share is about almost $7. So the actual fair value would be about $310. We take away the $7, and that's how we get that we'd like to pay below $300 per share. MasterCard also has about 0.5% dividend yield, so that's a nice little add-on. But right now, at the current price at about $350 per share, well, it looks like MasterCard stock could be overvalued. Now let's jump over to Visa. Now Visa stock looks like it's much closer. Right now the stock's trading at about $215 per share. We got a fair value using a 7.5% required rate of return of about $213 per share. But I also want to point out, look at the impact on a per share basis of the debt. For Visa, it's about $1.52. But we saw for MasterCard, it was about $7 per share. The primary reason for that is on this MasterCard one, well, we can see that MasterCard has about $14 billion in debt and about $8 billion in cash. Meanwhile, Visa has about $18 billion in cash and about $20 billion in debt. Hence the smaller impact. That's one of the reasons that we don't want to just look at the debt numbers and say, okay, Visa's worse off because they have more debt. In this case, yes, it is true, but they also have a lot more cash. So it doesn't impact the fair value quite as much. And just so everybody's on the same page, as I mentioned before, what we did is we took analyst estimates. Those are the green numbers over here. We then discount all of those, including the ones that the computer did for us. We discount those back to today, and we come up with our fair value of $213 per share. I don't mind using analyst estimates in this case because we have plenty of analysts projecting those numbers. So overall, I actually already have Visa in my bullpen. It is a stock I'm interested in owning, although I have not pulled the trigger yet, partially because I don't really have the cash to take a full position at this time. I do not have MasterCard in my bullpen, although I am going to add it. Now, when we go back to MasterCard's fair value calculation, sure, they're trading at a greater premium overall calculation of fair value, 303 to 351, but I actually think that part of that is deserved because of they have a higher growth rate, and that growth rate, if they were willing to cut back on their incentives, they could drastically improve their numbers if they decided to. In the meantime, if I were an investor or as a potential investor, I don't mind sitting there waiting for them while they're ramping up growth and ramping up their overall numbers, because overall, both Visa and MasterCards are two companies that I like. I have personally liked the way Visa has been valued better, which is why Visa has been my number one go-to on my bullpen. This is the stock. If I could buy the two, that would probably be the one I buy first. But MasterCard's not too far behind. So if you're looking at the two of them, it could make sense to take a position in both if it fit your overall portfolio. If I'm only picking one, for me, I'm picking Visa. But I do understand the story behind MasterCard. The only question I have about MasterCard is if they did slow their incentives, which have been consistently higher than Visa's for a while, how much would that impact their growth? Are they doing those kind of incentives because they need it? So that's the reason I hesitate just a bit. Now, if you're looking to sign up for this website, if you want to get access to this website, again, we're locking in the price for anybody who comes over and signs up before it goes live. It should be up and running by the end of the second quarter. So if you'd like to, I will leave a link in the description below. Get a link right here. Thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.